So you've been wanting to research companies, but you don't necessarily have the time to do it yourself, or you don't know how to do it yourself. In this series of videos, I'm going to be going step by step through my entire process from beginning to end on how I find companies, what I look for when I do my initial research on the companies. If they pass my initial research, how do I value and evaluate them after reading their financial statements? I will go step by step, including valuations when we get to that point, in how to evaluate companies. My name is Jason Rivera, and welcome to Value Investing Journey Case Studies. Hey, Jason here. In part one, or the first preliminary analysis case study we did, I said with San Miguel Corp that I was going to do further research on it. After thinking about it some more, I realized if I was doing that, I was going to be violating my own kind of rules that I have, which is if something's close, in terms of, and that company was close in terms of being a potential company to invest in, it's typically a no-go for the time being, at least until prices come further. So we'll talk about that one again, but we're going to keep moving on with the preliminary analysis case study at this point to find what I like to call a screaming buy opportunity. So today we're going with RRETY. It's Retail Holdings Inc. Okay, 423. Same process again every time. I've systemized this pretty much completely. 2.4 rounded up. 0.8. Get out of here, notifications. Oop, got those in the wrong spot. So, operating margin 4.4, trailing 12-month period. Plus 4, plus 4.6, plus 6.6, plus 3.3 equals 4.5%. So they're right on average, 4.5. Share price has grown a ton since 2012, which isn't good. Typically, from 42. To 139 million. So it's risen 2.231%. Book value is a little bit higher from 2014. 14 2696. So 13%. ROIC is 8.4. 7 plus 8.1 plus 7 plus 12.9. And again, I can tell that their debt levels have fallen over time because these numbers have gotten closer together. So so their average is about 10% over the last 5 years. So their margins are falling a little bit. ROE 10.4. Oof. 10.6 plus 10.4 plus 9.4 plus 12.6 plus 18.9 over 5. So their average there is 12.4%. Free cash flow to sales about 3%. And over the last 5 years is going to be lower than that, 2.8, 0.5, minus 1.1, minus 0.1. Or about 1%. Debt levels have fallen over the last 5 years. Yes, there's the big number right here that we saw. Right now it looks like they have a net cash position on their balance sheet when comparing cash to debt, which is good. I'll go back to that. Cash conversion cycle has risen a lot, which isn't good for a retailer. So minus 52. And what year was that? 2012, 11. 14. Just round up. By so 66 days. Wow. That is a lot. Or there's a 66 day difference, which is a lot. So what was that? Okay, I'm just going to skip that because I can tell already that this isn't going to be a company we're going to want to look at most likely unless something spectacular comes up on the balance sheet or on these numbers right here, which I highly doubt. So go back, calculate TV. So 2.42423. Oops. So 125,387. Oh, that's not what we did last time. What we did last time is we converted that to Filipino pesos to get the full number. Okay, so 125,388 minus 12718 plus 6576 minus, this one does have minority interest as well, 2978. No preferred stock though, so their EV is 116,268. No, I converted them to US dollars last time, so we're doing a little bit backwards this time. Same difference though. And all these numbers are Filipino pesos because I converted the market cap from US dollars to Filipino pesos. As long as everything's consistent on this side and this side, it doesn't matter which numbers you use. EBIT, trailing 12-month EBIT, which is 1508 plus 1557 plus 1465 minus 6 4524 4524. And again, these are in Filipino pesos. So actually I need to adjust that number because these are in millions. So okay, here, so we need to make everything consistent. So no balance sheet, what are these in? Nope, everything is consistent. These were in millions. So and again, with foreign companies, you need to be cognizant of this kind of stuff, making sure everything's consistent. As long as everything's consistent, it shouldn't matter, or it won't matter in the calculation. 116,268 divided by 4524, 25.7. 25.7. Oops. And then there, oops, 6268. Free cash flow is again trailing 12 months, so we want the last 4 quarters, and that number is going to be even worse. 4816 minus 1676 minus 587 plus 787. 3340. 3340. So this company is massively overvalued on this one relative valuation metric. 3340. So 34.8 gross. Again, I look for anything under 8. So this is showing me that on at least this relative valuation basis, this company is massively overvalued at current levels. How do I know that? Because then you get the earnings yield, you invert it, divided by 116,268 to find out the earnings yield is the estimated amount you should expect to earn if you were to buy at today's prices. If you were to buy this company at today's prices with all the currently available information, this is the amount you should expect to earn owning, if you were to buy this company today in the next 12 months. That is low. I never buy anything for this low of an amount. 3340 minus 116268. So that's even lower, 2.9%. 2.9. So, oops. This company is massively overvalued as of today. I'm not even going to do the notes section because it's pointless, because their margins are subpar compared to what I look for. They've been diluting shareholders at overvalued prices, which again is not a necessarily bad thing, but it should increase their margins more than they are. They should have higher margins than they are if they're diluting shareholders to allocate that capital, and they are not. They don't produce nearly as much free cash flow as I look for. I look for this number to be over 5% on a consistent basis. It's been under about 1% over the last 5 years on average, and this for a retailer is really scary. This means that they are having a harder time selling that inventory, which means they might have to write down some of the inventory, which will lead to possible destruction of balance sheet value. And if they're also having trouble selling their products as fast as they were before, that also means it's taking them longer to get free cash flow and turn that money into cash and higher margins and profitability, which they then can buy more inventory and kind of keep the cycle going. So this is a complete no-go. RRETY, complete no-go right now. And I mean, that's pretty much it. Complete no-go, and we'll move on to the next company in the next video.